Do you think this market is fingered by somebody? I do not believe that we are in a fair price finding market anymore. I'm not seeing it.
I mean, two things.
Price discovery. Yeah. Price discovery is fucked up.
Yeah. There are some things that don't add up, and whether or not, JP.
Holy fuck, this shit, it's a dinosaur. Jesus Christ, what the fuck?
Welcome, ladies and gentlemen, to another issue of the Grey Market Talk between, I'm being not modest here, Thorsten Wegner, a humble market maker who is quizzing his friend Nick, the master of macroeconomic trades and knows where the market is saying. That's why I got myself first in. Hello, Nick. Good to have you here.
Good to see you, Thorsten.
For everybody who has not seen us before, which is pretty much the rest of the world besides our 600 regular viewers, quick introduction. I was a market maker. I retired at Bear Stearns as a partner for the derivatives department for the European market. And Nick is a chief investment officer or former chief investment officer with over 80 billion assets under management under his belt. So which means Nick used to be my customer, and I was trying to do everything possible to make him happy in his daily tradings. That's the background. And now we're talking about, we already had in the green room and said, let's put the camera on, Nick. What's with this shit market? Do we still have a proper price discovery going on here at the moment? And I'm not complaining because I lost money. I didn't. I made money. But everything I've ever learned in the past throws me back into the early 2000s where you think, no, price discovery is not happening here anymore. Any thoughts on that, Nick?
There's certainly two markets today. There's the treasury market,
yep,
and then there's the equity market, and they both seem to be thinking something different.
They're a bit at odds with each other, right? The treasury market tells it's going to burn down everything, and I'm making money on my bills and chill. You heard that on this channel before. For everybody who's watching us, I like the short term, and that is trading like the biggest fucking recession of everything is just around the corner. And then there's the equity market making new highs.
Yeah, indeed. And that's the problem, isn't it? So we're in this state where the stock market is basically, it's all fine. You look at the bond market, and as you say rightly, we actually spoke about this in your virtual trading room about 2 weeks ago, where where I explained about one thing I always follow is the breakdown between what yields are. So 10-year yields are real yields and inflation expectations, and for a while, inflation expectations have basically been sort of fairly flat. And that's why I've never really cared about inflation, because I think, the market's kind of sussed out that we're going to head down towards a, 2 to 2.5% level. Of course, we can worry about what happens after that. We don't know, but that's why we buy gold and Bitcoin. But the other part of the yield has the real yield, which is really about the growth. It just went sort of really sharply down. And that effectively is saying, the bond market is more concerned about the risks of recession. And if you're really worried about recession, then, surely you shouldn't be so euphoric about all of the earnings that are coming from the stock market. You shouldn't be buying small caps. Why are stocks going up? And initially, it kind of worked as an idea, because immediately after we discussed this, stock market just fell. Tanked. But lo and behold, underneath there were those hands which caught the market and gently pushed the market back higher, whilst the bond market was still saying, we're fearing about growth expectations.
Sorry to interrupt you there, but you might have an idea, as you actually told me in the green room earlier, who might these helping hands, or how I call them, the plunge protection team, be, and how can they operate? Obviously, we're talking just about rumors here.
Yes, indeed. But I mean, okay, so we won't mention names, but the largest financial organizations in America, dare I say it, seem to have access to all sorts of information. probably as a reward for the fact that they make sure that the market does ahead of elections what it's supposed to do. I mean, it's all speculation and all rumors, but it doesn't quite fit, I must say, and therefore, you have to just go with the flow. And
you read these rumors on Reuters, just for everybody.
Yeah, indeed. I mean, that's right. I mean, rumors of certain banks receiving CPI numbers ahead of the CPI.
Yeah, because I haven't heard of that, and I was righteously outraged about that, because in my book that is still insider trading. Yeah, guys like you and I, we would go to jail for trading on information that is not available to the whole market. And that's where my line with the plunge protection team comes in, because how S&P markets traded. The last time we were on the air, we said, fine idea for straddle. You would have made tons of money with that already. Yeah, we were testing it, new all-time highs, and then we took the dive, which was in line with, well, price discovery, normal expectations. And suddenly, that was my impression, somebody was painting the tape. We did not go under that crucial 100 days moving average or whatever. And big orders came in without any reason whatsoever. Shortly before that, you saw somebody pumping down the VIX futures, because markets now look, is volatility subdued? Then it's cool, then we can buy longer. And then you had this complete getting the shorties out of the market, getting everybody out of the market who was positioned on the day trading side for the fall that yet did not happen. Yeah. And somebody was behind that. And everybody I spoke to, classic portfolio managers, they weren't in a rush on a random day in September suddenly to go along the markets.
So, I mean, apart from the fact that we said that the government bond market is pointing a different story to the equity market, we also have the credit market to look at. Yeah, I mean, for clues, what's going on, and one of the things we discussed 2 weeks ago was what's happening with credit, while stocks are sort of going gun ho to make a new high. Our credit spreads making new lows, and they weren't. And that was another reason to be bearish at the time and, follow the September sort of cyclical thing, goes down. And as you say, it didn't go down too far, it's gone back up. But credit spreads are not getting tighter. So again, you've got, even not just in government bonds discrepancy, you've got at the moment a discrepancy in credit spread. So
but they're also not widening, are they?
They are a bit, and I sort of looked at charts before we came on air, and it was a chart I looked at 2 weeks ago, and it's kind of even more looks a bit odd, is all I can say. But what's that mean? Have the markets gone up enough to say, the bounce is good, new highs? Well, some stocks, it looks okay, but in other stocks, it doesn't. I mean, we're still at this sort of, for people that follow it, the 50-day moving average, straddling that kind of level.
Yeah.
And therefore, in terms of technical talk, this whole movement, especially in things like the NASDAQ, looks almost like a triangle. So it went down, went back up, we didn't go all the way up, we went back down again, and now we're going back up again. And it's got a very sideways and kind of make your mind up time, which is normally a triangle. And it's certainly forming that way. Not all stocks are looking like that. Some are looking very bullish, but others are sort of this sort of undecided, not convincing, needs a bit more of a push, needs a Friday push. I mean, it's Friday, isn't it? I mean, this is normally the day where, they have another go.
Oh, yeah, that's the Friday the 13th. We're actually recording this. So if you listen to that, the crash might happen a little bit later. Yeah, it will be the worst crash of all times. Honestly, it's not going to happen today. Most likely not. Yeah, never say never. But you described it quite nicely. We have this framework. We have the bonds saying one story. We have equity markets saying another story. And now you're telling me that credit markets are slowly moving into, say, it's not nothing to see here, like Jim Bianco quoted in one of his LinkedIn articles. If there's something to see, that's actually where one should get concerned about what's going on.
Yeah, I mean, because look, when you look at, again, let's go through this. When you look at the data's not really that bad. It's not really pointing to big recession,
Yeah.
huge unemployment, it's kind of okay. So if it's kind of okay, why are the markets sort of predicting 2.5% rate cuts over the next 18 months? I mean, it's quite hefty given the Fed, are sort of very cautious, haven't reached the target, don't really want to jump the gun, want to be sure. So why are they doing that? So there must be something there. Excuse me 1 second, whilst I decline this. So there must be something that is that's really stressing the markets right now, and things that are not so obvious, which are still lurking in the background, we've spoken about for a while, is money supply. So money supply is kind of going up, but it's not really going up as fast as it ought to for an economy which is supposed to be in okay shape, and therefore there's this in the wings that potentially is could be the kind of thing that, and there is a delay with money supply and how it impacts an economy. So it could be something like that is kind of pulling at the other sort of string, as it were. But the bottom line is, as we've spoken about, it could go up, it could go down. Let's do a straddle, because we don't really know, and so on and so forth. I say exactly the same thing to my clients, as it were. The idea that we've seen the big move in bonds. I don't think we've got another big move in bonds. So, I showed you the charts last time about the 10-year yield reaching this target area, and we're kind of we're still bullish, but we're kind of now, we've seen that big move in yields down. So if there's no more big move in bonds, let's just say down to 3.5%, we're in a range 3.5%, 4.5%, we're sort of getting close to the bottom end of that range. In stocks, we kind of said 6,000 eventually, but perhaps not all in one go and not all now. And why now? So we're bound to see some kind of retracement. I think you've seen the big moves in markets, and for that reason, I think you're meant to be really trading the ranges. Sort of almost, I won't say day traders, but your positions are not really investment positions, but rather trading positions.
Oh, it's. I think before the election in the US, that more and more crystallized. We discussed that in epic length. What's going on there? Huh? We've seen that before. I remember that we started already getting bearish November, December 2019. Yeah? All the data looked already like, no, market's going to suck. Something's not right here. And then we had the catalyst, Corona, coming in. Yeah? And we had this big bloodbath. What I'm seeing at the moment is, if you would take all these weird orders that going into the equity markets out of the equation and just talk to the normal price discovery guys, they would say not necessarily there's a crash tomorrow, but they would say, I don't have to risk it now. It doesn't make any sense. And then we see these wild moves while we still have relatively high volatility. So one of the things that is forming in my mind is actually, that is not trading recommendations we're giving here, but I thought, okay, if you have a closer look at the VIX, what's the VIX? When the VIX expires, it actually transforms a nice cash position, the futures. With these futures, when it expires, you get cash. And for this cash, you could buy a nice bond portfolio, which then lasts 30 days. Yeah, that's the nature of the VIX. We look 30 days into the future. And I thought, what's happening next week? Next week is the September VIX futures expiring, and then you're switching into the October VIX future. The October VIX future is already carrying a portfolio implicitly of stock options on the S&P, which is covering the elections, right? So if I'm now saying, okay, from next week on, if I'm long the October future, even if it expires before the election, I could already have a nice portfolio of stock options on the S&P, which will cover me for eventual weird things going on in these elections. So I don't think that volatility is going to collapse. If we go back to 15 levels, I'm definitely on the buying side, if that ever happens at the moment. But that could mean everything is possible to the upside until we see the election in the United States. And who is interested to keep the market at elevated levels, the equity market at elevated levels after the election? Nobody. And why nobody? Because they all need far lower yields, Nick. How do you get far lower yields without making an excuse why we see quantitative easing and taking yields down? If we have a big, massive correction in the equity market, and we want that after the elections. Is that a scenario?
Well, a good scenario. I mean, that makes a lot of sense. It's very plausible, and I also kind of see the same way in that if we say that the market is supported for different reasons, the support has to go after the election because A, you don't need it, and B, you don't want somebody catching the portfolio saying, "What's that thing over there?" So you have to get rid of it. So as it were. But I do think that obviously a run up in the towards the elections. I actually sort of really did see September sort of seeing a bit more of a sell-off, not just the cyclical pattern, but I actually sort of thought the targets were a bit lower. But from October, rally into an election and then basically dump it, as it were. That was kind of my sort of path. But what you say makes a lot of sense. But remember, the bond market is already forecasting interest rate cuts. That someone somewhere says, "Hey, the curve is already 2.5% down. So what do you want to do?" I mean, real yields, something like 1.6%. They're coming down from 2.5%. I mean, that's a big move. That effectively is someone sort of forecasting a reduction in growth expectations. And that sort of declining growth expectations means at some stage the stock market sort of earnings expectations and the economy growth expectations are going to get back in sync. And until they do that, the market's going to look like crazy kind of independent things.
But in our long careers, we have seen that many times. Yeah? If you think the equity market is right and not the bond market, you always learn the lessons. The bond markets are far bigger than equity markets, and the bond boys get it right every time. Equity markets might do weird things for a time because the investor sentiment is different. Yeah, less math, more hope in that. But at the end of the day, the bond market always wins. And if I reflect, we discussed that on the show, started a year ago. The maturity wall coming in for the smaller companies, right? Especially you just mentioned the Russell 2000, yeah? That's where you actually want to go in because they would benefit if interest rates yields are coming down and they have cheaper refinancing. So this is still in progress, right? They need to get interest rates down. The refinancing wall is here and the bond market has already facilitated for that. Maybe it's not enough, but it's this scenario at the moment where I think are markets manipulated or not? And I'm coming down more and more on the side of something is going on which I don't understand. All the little bells and whistles don't fit together. And the biggest culprit in the room is the S&P and the Nasdaq at the moment, especially with these sharp rallies to the upside. We saw when was that, on Thursday? Minus 1.5% down during the day. Then the buy orders come in and we close plus 1.5% up. This is not what you usually see when you come out of a recession into a healthy bull market. Or no, maybe that's wrong. These are the moves you see on two parts in the quad model. At the end, when markets don't know what's going on and when everybody has sold everything, nobody believes markets will rise again, then you see violent moves at the beginning of a new trend. So the question I'm asking myself is at the end of a big trend or is at the beginning of a new trend and we see S&P 8,500 in 2 years' time?
Before I answer that, the movement of down 1% and then up 1% has happened apparently 9 times in the last 30 years. And in all of those prior occasions, the S&P, I think a month later was down on average, something like 1.5% or something very close to that. It's not sort of a collapse or anything like this, but it just means that, these kind of haywire days that you kind of get I always categorize them as topping behavior because, people don't really know. They're not really convinced to sort of take it all the way up. And the people who want to sell it, they kind of lose energy and they take profits very quickly. So this kind of feels like a topping pattern to me. As for the 8,500, in order for us to have an 8,500 S&P, then something really substantial needs to happen. I mean, divide 8,500 by 20, then you're at sort of 400 earnings for the S&P. we're a long way away from that right now. We're about sort of 250.
Don't quote me on that, Nick. Not that I actually
No,
really
but I mean,
think, but you're absolutely.
I think 6 is definitely sort of a realistic thing until the equity analysts reassess, what's happening with earnings, and it's not just Nvidia, and that it is sort of a much broader group of companies.
No, these high volatility days, we just and I agree with you. Yeah, that looks for me like we're trading at the top when things like that happen. Just everybody, and that's only a couple of years ago. We've seen that in March 2000 when the market had finished its correction. Yeah. But before that, you had a surrender in the market. We saw huge volumes, people crying on TV publicly. The end of the world was nigh. And then we built out this bottom, and then we had in the move up, in the V-shaped correction, then we had these high volatility moves in there. So there are 2 points in the market where you want to see them, or where you can see them and take your observations out. One is after a huge market correction with huge volumes, when the spirit changes again, then you have these moves, or at the top. And at the moment, I think we are far more closer to the top than to the bottom. And that was the example. I said, if I would interpret these moves as the moves that usually happen at the bottom of a market, then you would see an S&P at 8,500. And I'm not seeing that. Huh?
Sure. And of course, the other thing we haven't talked about, which is also, question mark, does it really fit with what's going on in the market, is what's going on in Japan. And of course, we had the major banks, we'll leave it at that, who kept on saying, oh, it's over, no more sort of leverage, and, it's all over.
Yeah.
Well, look at where the yen is now, and look at where the stock markets are. And effectively, the fact that the yen is continuing to strengthen suggests that there isn't any of this sort of leverage selling of yen and go and buy some of these other high yielding markets, including NASDAQ and so on.
Yeah.
That's not taking place, but nevertheless, the NASDAQ is still, and the S&P is still fairly in the sky. So without all of those buyers from sort of that kind of, they're gone. So who else is kind of holding this?
Is it maybe again our cleanest shirt in the dirt hamper analogy? Because you had the numbers in Europe and Germany. Yeah, we still pretend we are not in a recession, and it looks horrible. The whole of Europe looks horrible. Lagarde had to take interest rates down. Just on a personal level, they're telling me inflation is not a topic anymore. I just opened a letter the other day, and my energy provider, I changed as soon as I got this letter, said they have to increase the price for electricity by 25%. And you click up your sheets and say, what are you trading? Yeah, what are you on? But I'm not the only one who gets this stuff. And you think, no. So would you want to buy Europe at the moment when we're just before Armageddon? I think, everything will break together. The longer the German government stays in shape and does their weird things, which is destroying the economic base we have here. China, everybody said, oh, China's going to recover. Bullshit, they are. Yeah, they are in big trouble. You read again, Richard Koo, the balance sheet recession, Dojin. He's still working his ass off in China, advising people, and it's not looking good over there. So you don't want to invest in China. You don't want to invest in Europe. Japan has now a question mark behind it. Even though you're still bullish, I was bullish for a long time. I don't know what's going on there now. I'm not so convinced anymore. Where do you put your money? Good old United States. The worst.
Well, you don't see that in the currency, though, do you? And that's the thing. You certainly don't see it in the currency, because and then comes back to why they're cutting interest rates.
Well, then
because you're paying 1 trillion in interest.
Then we could say banks that shall not be named, who are rescuing the market over and over again, they have dollars in the United States. They don't have to swap around. They can simply use the dollars they have lying around in their own country. So you won't see that in the cross rates.
Well, of course, that's that's the other thing. The US dollar is now much more competitive. US is much more competitive around the world than it was, let's just say, a couple of weeks ago, and a couple of months ago. Trading at 100, the Dixie is, is substantially cheaper. And it sort of, at a time where you want to put tariffs on the Chinese, whoever comes into power, and you want to slap some more tariffs on them, I guess, if the Chinese are not sort of stopping their currency from appreciating, maybe they get let off a little bit more in such circumstances. But it is a strange market, I must say, and for that reason, I've lightened up. The only things I don't lighten up on, however, are those gold things and the crypto things,
Well,
which is I just looked at the chart again today, and those little boxes I drew for you last time, bang on the day. I mean, this is this is really good. Fingers crossed that it holds. But yeah, I mean, those gold still looks kind of okay, and crypto is definitely okay, and maybe that's sort of part of this support from the fact that the bond markets, as when bond yields fall, collateral is worth a lot more, and so strictly that's kind of more balance sheet capacity in the system for people to lend on. But I don't know. I mean, would you really want to, sort of leverage yourself into NVIDIA at this level? I don't know.
Well, let's put it that way. There was one little side note, and people were not talking too much about it. Somebody brought a bill into the House or the Senate that banks need to have less collateral in the future in the United States.
That's capital, probably.
Yeah. Why that? Why would you do something like that? Markets are at a peak. Yeah, they are at a peak. Apparently, great. Everybody's doing fine. Banks handing out loans hand over fist to keep the economy running. And now you think, you know what? Yeah, let's put more fuel on the fire. When would you do it?
I haven't read that story, but I know about a year ago there was a lot of discussion about the banks having to increase.
The whole Basel IV thingammy going on.
Yeah, but it was almost like the Americans were going to sort of increase, or at least these super duper banks that exist around the world. That if they go under, so does everyone else. And I always believed that the way that they were going to tweak the rules would be to allow banks to put more government paper on their books without having to sort of account for their sort of limits and therefore effectively be the buyer of last resort for the buyers of last resort of the people who issue treasury debt. So, the banks just take the role of the Federal Reserve in the same way that the Bank of Japan is kind of pulling out now from buying Japanese government bonds, and all of these Japanese institutions kind of taking their place. So, I believe that would be the chosen route in order to deal with this sort of debt problem.
Well, they've done it after Corona. Yeah,
they did do that.
Zero reserve policy in the banks.
Yes,
and that would be the explanation. You facilitate for the banks to be able to hoover up assets, equity markets, real estate assets, all the things that look a bit dodgy at the moment. How do you do that? You will have the banks that shall not be named, CEOs, going over to you and say, "Yeah, fine, we could do that, but." Reduce the requirement for us to keep lots of equity on the books. Then we can do that, surely. And then you see moves like that happening. First of all, as the rumor said, there are information dished out to some, not to others. Then you tell them, yeah, we give you fresh petrol to light the fire a little bit more. And in the meantime, let's shift my other conspiracy theory. Let's shift all these assets from the professionals to the suckers. Then the election is over. You can filter it in the market on the way up, like Warren Buffett is doing it in public. He has now over 200 billion in reserves lying there, sold his Apple. Yeah, sure. His thought was, no, Apple is a crap company. No, he wants to hold Apple for the long term. Yeah, I completely see his point. But in the meantime, you can do a bit of trading. Yeah, you can buy it back 35% cheaper. So is that what's happening at the moment? Are they filtering in their equity holdings to the targets? And the targets then will be taken out. And after the market brings in a nice correction, 20, 30% whatsoever, they're going to fill it up again. And that would happen most likely this whole scenario after the elections.
Well, that would be an interesting storyline, but
I write a book. I write a book about that then, which we can publish in 20 years' time. And then people, that was it. That's how they did it.
Fading rallies, you do need a rally to sell your stuff, right? Yeah. So that's for sure. And therefore, if you've got a huge position in something, then, there is only one way to to get your paper out there, and you can't really sell it into a hole. You've got to sell it into hunger, as it were.
That's what we're seeing. Demand. That's what we're seeing at the moment. Yeah, not supported by the bond market, not supported by the credit markets, but equity markets like FOMO again. Oh my God, I missed buying Nvidia at 100 or at 98. Oh, I have to buy it now. Apparently, what has changed? They had numbers coming out, and the numbers looked okay. Yeah, super. But the margin, no growth there. So, but I have to have it now.
Still pretty stonking, but you're absolutely right. The kind of, the market read that as, they've peaked, but they've peaked at an incredibly high level. But, coming back to, fading rallies, and you need to create a kind of a bullish environment for you. That's sort of market manipulation of the highest order that was classed as illegal when we were growing up. So, but who cares?
Well, things are not illegal if a government does it. Yeah, if I come to your house,
it's not illegal if you make the rules.
Yep. So, exactly, and you can always change the rules. Yeah, and now we've reached a world where you actually change the rules back into the past to make things. And just as a last point, I was listening to these economic policies coming out. Trump wants to have tariffs. Okay, fine. I'm not a fan of tariffs. I think tariffs at the end of the day make capital less efficient. But looking for the American people or the American billionaires who want to have their stuff there, fine. And then you have Mrs. Harris saying, oh yeah, we also want to tax profits that are not yet realized. What will that do to a market? And she's not talking just about the equity market. She's also talking about your mansion in Florida you live in, which has appreciated in value 3 times. What are you now supposed to fork up tax on that? Huh?
Yeah, I mean, obviously, you don't have to sell your place to pay for it. But I agree. This notion of unrealized capital gains as an idea. But, if you sort of put that into context with all of her other ideas, and then, everyone said, oh, yeah, the market's going up because there's a much higher probability of Mrs. Harris becoming the next president. Yet all of her policies smell like the people who are making the money today are frozen. It smells like that the people making the money today are going to have to pay for it all, because Trump's idea is that he hopes to tax other countries. Mrs. Harris's idea is she wants to tax the people who are kind of in the top of the NASDAQ hit list. And yet I don't see anyone building in any concerns that net income is going to be substantially lower, nor do I see people who are looking to get out of assets where there are lots of unrealized gains. So a question mark. The whole market is a question mark.
That's why I have these 2 negative scenarios. Let's start with Harris first. Her policies are stupid. Yeah, it's just stupid. The socialism never works for markets. Markets don't thrive on socialism. Yeah,
unless you're broke.
Laffer from the Laffer curve said, "Have you ever seen an economy that taxed itself into prosperity?" Now it's not going to happen, and it's not going to happen now. So bad for markets generally. Now we have the other guy, Mr. Trump, sitting there, called President Trump because he used to be president. He wants tariffs, and he wants to show open, like Warren Buffett said it once, when the tide comes in, you can see who swims naked. So, okay, he's reducing bureaucracy. He wants to introduce tariffs, and we know that there's a huge misallocation of capital. If you reduce bureaucracy and you lay open the misallocation of capital in a market that's too highly valued, that's also not good for the market. There will also be a bloodbath. So we have the choice between, what is it, poison and...
It's bad or worse. And
bad or better.
bad or and in the end, and the market is still very excited, of course, because, they believe that the only way to deliver such policies, either, sort of A or B, is for the Fed, or let's just say now the banks, to be in there ready to sort of buy all of the bonds that are being issued. Or maybe Trump says, you don't get tariffs, but you got to go and buy a lot of our bonds. And maybe that also works. But yeah, I mean, the market is sort of euphoric because they're saying, well, that just seems like a reflation again to me, if you ask me. So, and they're all getting excited about it. I'm not so sure. I really am not so sure. Bottom line is it's a confused market. Everyone sort of therefore, is very conspiracy type thinking. I just think, people are having to go one way or the other. But I would say in a market that doesn't convince one way or the other, I'm fairly neutral. I still got my core positions, and which is I still lean towards things like Alibaba. I still lean towards being short of Google. I mean, Google is awful. It's a stock right now, which is good. Alibaba is good, which is good. Gold is good, so that's the other thing, and crypto is hanging on in there. So let the noise be the noise. But if you kind of look through all of this noise and say, okay, I mean, I don't have to be involved in these sort of question mark markets, but what does it also look like? The bond market looks a little bit overcooked right now, unless there is something desperate that's going on. And I think once the Fed don't do 50 basis points in September, a lot of the kind of euphoria that we saw in January of this year might also come off in bonds, and we might get a bit of a sort of more equalized market.
So you think the trade for next week is really, if they only come out with 25 basis points, we'll see markets...
I think the euphoria will come off. I mean, they won't necessarily say, "Oh, yeah," but therefore they won't. We're not going to go for 250 basis points. Therefore, it's only 200. I think they'll just sort of put that for the next meeting and the next meeting. But I do think some euphoria will come off because of that, and therefore, if you look at TLT, it's bang on one of your cones, as it were. So, for me, I'd say you're in the kind of expensive area of the bond market, and I'm sort of, I wouldn't play it for the last 10 basis points, frankly. I think, everything is, you've built in already 250 basis points. Your long end is already as rich as you like. And you're only assuming 2% inflation for the long end. So why would I need to buy it? I don't really like bonds here.
Isn't the Fed in the situation of a parent? How to motivate your child? You can tell him, you get the cake now, but that's it. Or you say you get a smaller piece of cake now, but I promise you for the next 3 days, you always get a small piece of cake. And that in the end will be more cake. So if the market is a misbehaved child, what does it want? Does it want now the cake now? Or it throws a tantrum, or is it content and actually has the logic in there to say, oh yeah, I take a cake now, and then you have an eye on it and make sure every day after lunch I'll get another piece of cake. Where do you see?
The children are restless. And when the children are restless, you let them go outside and play. And I think that's what's going on right now. The market's a little bit restless and it wants to go and have a play. And I think, let it play, but if you take all of this noise away, what are the things that are moving, right? What are the underlying themes? And the underlying themes are, we talked about interest rates to come down. They've come down, and they've come down quite substantially. Yeah. And therefore, that theme has worked. And I'd say it's nearer the kind of end of that move rather than at the start of that move. Therefore, Do I need to be involved at the end? No.
Yeah.
In terms of, sort of plays on individual stocks, I think there is still a game there. Gold is a little bit tricky because, it's one of those.
Murat said the other week, short term, he would like to short it a little bit. And I said, fine, if I had the timing skills you have, I might agree with you that we're a bit overboard and that we'll see a correction. However, I don't have these timing skills in gold. I just say, fine, if it comes down, I'll buy some more because this whole thing is fishy going on. Sure. And I had another chart. Was it, what's the biggest gold producer in the world? I had this chart. Barrick, yes. And somebody posted the gold production of Barrick since...
Yes, it's falling. Yes, indeed.
Since 2005. And we are now below the levels of 2005. They reached a peak in production at 2006. So the supply in gold, if Barrick is an indicator for the rest of the industry, yeah, less gold, more demand for it, not less, at least the central banks who want to hoover this up. I'm still positive on gold, Nick.
Yeah, indeed. I mean, we talked about gold a long time ago as being the safe haven in a portfolio that used to sit. The treasuries used to be the 60-40 thing,
yeah.
And then you had a little bit of gold. As if you can sort of 60-40 and 55 maybe and 40 and then 5 over there. But gold is and will be a much larger part of people's portfolio. And I think the bond part of it won't be for different reasons. Yeah, because until the governments, get their act together and are able to finance themselves, in a proper way, and with rules and with limits. And until they do that, then I think it's a very dangerous game to be buying stuff that seems to be on an endless supply. I mean, you talked about Barrick not producing that much gold. If you want the other side of that sort of equation, it's the governments who are certainly producing as many bonds as you can get, as many as you want. Your size is my size, and they certainly need it. And that's why they need people to buy this stuff. And therefore, when somebody else wants you to buy it, I'd say the yields are not sort of, give them 3.5%. You're having a laugh. I mean, that's just, it's not interesting for anyone. And for that reason, I think, ultimately when the desperation shows, and it's not yet, those yields at the long end will be higher. So gold takes that kind of position for now. And, equities, well, they belong there. But we need to see some growth. And at the moment, we don't know what's going on with growth.
No, one of the positions I like at the moment is, I spoke about volatility earlier, selling puts on volatility on the VIX. Yeah, I don't see, first of all, it goes very fast to the upside and very slow to the downside. Well, it has increased a little bit, but I don't see volatility falling below 15 or 16 even at the moment. Yes, if it does that, just sit tight on it and have a look. We have this election piling up. So it's not a trade that makes you rich, yeah, but it's a trade where the risk-reward ratio looks reasonable. I don't know when we see a volatility spike, but I'm pretty sure that in this time to the elections coming up with markets in this situation, we spoke about that the last time. We saw new highs, but with higher volatility. Not a good sign.
Indeed. And with higher yield spreads and and don't tell me, that the world out there is less volatile. I mean, with, Putin talking about NATO now being engaged in the war with, this Middle East still unresolved. I'd say there's more risk of still an upside, jump in vol, irrespective of what's going on with the markets. And I don't see quiet markets. I see noisy markets.
Well, that's when old geezers like us have to eventually start real peace marches again. Because I remember the peace marches when I grew up, hundreds of thousands on the street, and there wasn't even war. Now, we have this crap going on everywhere, and nobody's on the streets marching for peace. So I never thought that would be left to me, but hey, eventually I might have to start it.
Yeah, that's something. That's when we're not shooting these videos. That's absolutely right.
Absolutely. Oh, one last thing. Hey, Nick, what are you doing in November? 9th of November, 10th of November, and 11th of November?
I shall be going to the best options boot camp there is.
Excellent. Thank you very much for that. I take that high praise. For everybody who hasn't heard it yet, I'll put the link in the description as well. We have another option and macro bootcamp in Seeheim, most likely, near Frankfurt. Otherwise, it might be a different venue, but it will be these dates. And I am able to have the majority of my team from the United States, from England, from all over, from Mauritius coming over. And if you're interested, have a look in the video in the description, whether that might be something for you. It will be held in German, even though Nick most likely will talk macro in English, I guess.
Almost certainly.
Yeah. Nick, thank you very much for your time. That was enlightening as always. I cannot wait for Friday the 13th for the markets. What's going to happen now? I really have this.
I didn't even notice.
I have this weird feeling that something smells very, very, very strange at the moment. And then we need just the one catalyst, right?
Yeah, indeed.
At the moment, markets can be dominated by names that shall not be, by banks that shall not be named. But they will overpower it if a catalyst comes in.
We didn't talk about that. We didn't talk about the Commerzbank and UniCredit, but perhaps for another day. But that's also a sign that it's difficult for these guys in an environment to make money, or they need to consolidate. They need to get their costs down. This is not good.
Isn't that the one thing old Marx was right about? Concentration in industry under capitalism. How he defined capitalism. Yeah? In real capitalism, you wouldn't see that. But in this strange mix we are having, yes, of course, you get bigger and bigger and bigger as a corporation, and the smaller guys don't have a chance. When's the last time that a bank was established in the United States?
Yeah, there are sort of
doesn't happen anymore.
Falling by the wayside. I mean, but obviously Europe's trying to compete with the West and the East, and it can't. It's tiny. But at the same time, it needs small banks as well, and they're just making them bigger. Anyway, that's a different story for another video or whatever.
Oh, definitely. Well, we can talk about that for hours.
Indeed. So, thank you.
I thank you, Nick. A last word from your side. Otherwise, I finish it off.
Finish it off.
Thank you very much for viewing our channel. If you like that, share, like it, and feed the algorithm for us. Hope to see you soon. Bye-bye.
Bye-bye.